Good afternoon, participants. We welcome you in this exciting session of corporate forex risk management. This session basically is in currency futures and options and exclusively for corporates. Today we have Mr. Ramesh Varedkar, who heads Commodity and Currency Department in ICICI Securities. And we have our research team also. And our endeavor would be to cover the important things in currency, which would be of use to corporates and take questions which participants would have given to us. And you can type your question in the chat box, and we will try our level best to answer all those questions. So over to you, Mr. Ramesh.
Yeah, thank you, Pankaj. Thank you for the introduction. How many of you would like to hedge FX risk and have a good balance sheet? Just type me in the chat box if at all you want one. Me in the chat box. Great, thank you. How many of you would like to make hedging process simple with very, very minimal documentation, which is one-time activity? Please type me in the chat box. Okay, thank you. Yeah, as Pankaj introduced, my name is Ramesh Varedkar. I head commodities and currencies business. And now we are going to discuss about corporate forex risk management using currency futures and options, maybe for next 35 to 40 minutes. And I promise you this 35 to 40 minutes will give our best, and whatever the knowledge information that we have, we'll be sharing with you. This program is purely a information dissemination or a knowledge series activity where we would like to tell about this product, how it can be used. Yeah, this product, which is currency futures and options for corporates, is for everybody. It is for SME who have got an exposure of, let's say, $20,000 per month, $10,000 to $100,000. This product is also good and useful for the medium enterprises who have 50 crore to 100 crore of exposure in exports and imports. And this is also good for the very large corporate who have huge forex exposure, who use forwards, options on the banks. They can use currency futures and options also. So this product is for everybody. It's not that this is only applicable for smaller companies or larger companies, and entire chain of these companies have been using this as a part of their risk management. So I'll start my presentation, and I request you to put your questions in the chat box in case you have any. And as Pankaj said, we'll take the questions at the end, and I'll also be sharing a feedback form at the end. Okay. Is my screen visible? The global currency markets? Okay. Yeah. First, I thought I'll explain you about how the global currency markets are. Forex is one of the largest and most liquid markets in the world. And as per the BIS report of 2017, the daily turnover of Forex across the globe is $6.5 trillion per day. Now, you might be wondering how much is $6.5 trillion. Just to make your calculation simple or easy, it will be close to 5,000 lakh crores per day. I've just rounded off the number to close to the zero, but it is 5,000 lakh crore per day. And the major trading centers are London, New York, Tokyo, Singapore, and so on and so forth. 85% of the transactions involve 7 major currencies, which is dollar, euro, pound, yen, Canadian dollar, Swedish krona, and Swiss franc. These are the 7 major currencies which contribute to 85% of the foreign exchange turnover across the globe. Even though there are close to 180 currencies which are approved by UN, but these 7 currencies contribute to 85%. And as it says, these forex markets never sleep. They are open 24/7. Markets open in Sydney in the morning, then move, and by the end it closes at San Francisco. The different products in forex markets are spot, forward, which happens on the OTC. Then you have futures and options, which trade on the currency exchange. So the first currency derivatives exchange or currency derivatives started trading on CME in 1972. This was about the global markets. Coming to Indian markets, are you able to see my screen on Indian currency markets? We talked about the global forex market. Coming to India, the forex or all the corporates have been hedging on the OTC platform. Earlier, it was only forwards, and RBI introduced options also on OTC market in 2003. And initially, it was only few select PSU banks MNC banks and private sector banks who started offering options. Even till date, all the MNC banks offer, private sector banks offer, and very few PSU banks offer currency options. So this is on the OTC platform. In 2008, NSE started currency derivatives. Currency derivatives, the regulator for the exchange is SEBI and RBI both, because it is a foreign exchange. NSE was the first exchange to start in 2008. They started with USD INR futures contract only. Then gradually they launched Euro INR, Pound INR, and Yen INR. These four currency pairs almost contribute to 94% of our market. Right? NSE also came out with options in 2010. BSE then launched currency derivatives. Just in 2018, as the markets have matured, it's been more than 10 years. NSE also came with the cross currency pairs. When I say cross currency pairs, it is the pair where INR is not there, like Euro USD, GBP USD, and JPY USD, which was launched in 2018. The volumes at exchange, NSE has been increasing. I've been tracking from 2008 onwards. 2009, the average daily volume was 10,000 crore, and last quarter of last year, the average was almost 75,000 crores per day. So which is almost $10 billion. So that's how I wanted to highlight. The markets are very, very liquid. Yeah, moving ahead. We have been talking about currency derivatives. Let's understand what is currency first. Currency is nothing but is generally accepted medium of exchange for goods and services in a particular economy, and every country has got its currency, and the exchange that they do with other foreign exchange, other country currency, is nothing but it's the foreign exchange rate. Let's say today USD INR is 73 rupees 30 paisa. It means $1 can be exchanged for 73 rupees 30 paisa. Right? And that's about currency. Let's understand derivative. Derivative is a financial product which is derived from an underlying asset. The underlying asset can be anything. It can be stock. So whatever is derived from stocks is the equity derivatives. Similarly, whatever is derived from currencies is currency derivative. And currency derivative, it's a contract on the exchange. It's a contract between buyers and sellers. And in between, you have a clearing corporation. And they agree to exchange X quantity, which is a multiple of 1,000, at a fixed date. And it's a multiple of 1,000 units. So 1,000 units for USD INR, GBP INR, JPY INR. JPY INR is 1 lakh. 1,000 is for Euro, Pound, and USD INR. There are two products on exchange. One is currency futures, and the second one is currency options, which are traded. And usually derivatives are used for trading, hedging, and arbitrage. So today, for corporates, we'll predominantly focus on the hedging. So these are the three exchanges: National Stock Exchange, Bombay Stock Exchange, and Metropolitan Stock Exchange, where currency derivatives are traded. Moving ahead, let's understand how is currency quoted. Okay, we keep talking about stock. When we say Reliance Industries, that's the price of Reliance. When we say gold is 48,000, it's the price for 10 grams of gold. But when it comes to currency derivatives are always traded in pair. Let's say it's like USD INR equals to 75. That means for $1 you can get 75 rupees. So basically the first one, which is USD, is called as base currency, and the second one is called as quote currency. And base currency is always 1. Similarly, you can look at Euro USD. Let's say Euro USD today is 1.21, but let's take this number. Euro USD equals to 1.2745, implies for €1, one can get 1.2745 dollars. So that's how the nomenclature is. That's how the currencies are quoted. Hope I'm okay. The speed is okay. If yes, then just type yes in the chat box. Okay, I'll go a little slow. Thank you. We understood about the global markets, Indian currency markets, right? Then we understood how the quotation is given. Let's understand appreciation and depreciation. I know this is very, very basic, but I thought we'll start with the basic because we have people across the SMEs or medium enterprise. So let's understand about the currency appreciation and depreciation. Let's say USD INR is 75 rupees, right? And in case it moves to 76, it implies USD has appreciated. So earlier one was able to get 75 rupees for every dollar. Now for every dollar, one will get 76 rupees. So USD has appreciated, whereas INR has depreciated. Similarly, if from 75 it moves to 74, it implies USD has depreciated, whereas INR has appreciated, because you get lesser rupees for that same dollar. So one is to understand the appreciation and depreciation. Moving ahead, we know that rupee dollar keeps moving entire day. The markets are volatile. What are the different fundamental factors which affect the exchange rate? One is capital flows. The more flows we have, more dollars into the market. So that's how rupee appreciates. Yeah. Other factor which is important is performance of equity markets. Both are inversely correlated. We have our equity markets are dominated by FII, so a lot of flows keep coming in or going out. That has got an impact on our USD INR. Policy decisions, like today we had a RBI monetary policy, repo rate, reverse repo rate, everything was status quo, but any change will have an impact. RBI also keeps intervening into these markets by being on either side. They buy, they sell on the currency futures platform also. USD INR also moves because of some uncertain events which happen, economic and political factors, and also global currency markets. So these are the different fundamental factors which impact the exchange rate. Yeah. Moving ahead, these are the few of the factors, economic events which make USD INR volatile. One is trade balance. So our country comes out every month with trade deficit numbers. If imports are more than exports, then obviously there's a trade deficit. There's a demand for USD, and USD appreciate, and domestic currency INR will appreciate. So this is how is the impact of that. In case of let's say exports are more, there's a lot of inflow of dollars, right? So then we have if exports are more and there's a lot of dollar inflow, what will be the impact? USD will depreciate and INR will appreciate. Similarly, I mentioned about the negative trade balance. Because there's a demand for USD, USD appreciates and INR depreciates. The third thing let me take is on the global commodities. So if global commodity prices are high and they are increasing, so there's a demand and we need to buy all these commodities in USD. So USD INR appreciates, and the impact on our INR would be it will depreciate. So on and so forth. So these are the few of the likely events and the impact on USD INR. I've just moved to the next screen. Is my screen visible? Who are affected by currency prices? Okay. I'm moving on to the next slide. Who all will be affected because of these currency prices? Yeah. Who are affected by currency prices? You all corporates who are into export and import are impacted because of this. Government, central bank is also impacted because we have almost $592 billion of reserve. Any price movement will have an impact on that. All the banks, financial market players will have impact who have exposure to USD, who have exposure to foreign exchange. Similarly, individuals, travelers, students will also be impacted because of this volatility or because of movement of USD INR. So let's understand what is foreign exchange risk. For all these corporates, what is the foreign exchange risk? Right? Since there is a rise or fall of our currency against other currency to which you have an exposure, right? It will impact your financial statement. It will impact your balance sheet. So that's what is the currency risk that you have. So the currency risk occurs in case there's an adverse movement and you are an exporter and you exported at 75 and let's say it moves to 70. So your receivables will be at a lesser price. So that will have an impact which will also impact your balance sheet, so on and so forth. So these are the transactions. This is the currency risk that every corporate has. So what is that you need to do? Yeah. One needs to hedge. So what is hedging? Hedging, the best way to understand hedging is think it's like an insurance, right? Why do you take an insurance? You take an insurance because in case there is some negative event happens, right? You are protected. So that's the point why you take an insurance. It doesn't mean that the negative event will not happen, but in case the negative event happens, the impact is lesser. That's the whole idea of hedging. In older days, the hedging they used to call whenever they used to put the cattle, right? They used to hedge so that the cattle don't go out. So that's the basic concept of hedging. Now, the same thing is used for managing your foreign exchange risk so that you are hedged and you don't lose because of volatility in the FX markets. And for hedging, there are different tools like forwards, futures, and options. We'll discuss about that. So these are the different tools for hedging, right? You can see the circle. There are 4 options that you can have. One is you can keep your exposure open. When I say exposure open, you have a receivable or you have a payment to do, but you have not hedged it. I believe any transaction of that kind is speculative. right? Because you're speculating. You don't know whether when you receive your receivables, whether the price will be higher or lower. So keeping open is nothing but it's speculating. The other tools are like futures or forwards, right? Forwards, which is done on the bank, you can lock in your price even though your risk reward is linear. Or there are options also. I believe options are best when markets are very volatile. You are not sure on the direction of the market. Options work very well. Or there can be a combination of futures, options, and forward also, which is the best as recommended by your advisor or the call that you can take. Yeah. So these are the different hedging tools. I'll just sum up, which is futures, options, forwards, and combination of all. Right. I'm moving on to the next slide, which is on options, right? As I said, there are so many banks, multinational banks, private sector banks, PSU banks. All these banks offer a spot transaction for you where you convert your receivables or your payables. Uh, you can also do a forward contract with these banks, provided you have a credit limit or you give some margin in case you don't have a credit limit. Have a forward limit and hedge with them. And you can also do an option. But as I said, not all banks offer options. It's only few MNC banks and private sector banks who offer options, and SBI, maybe in PSU banks. But when you take a quotation for option for the same strike price, same date from all these banks, you'll get a different code, and all these codes would be very, very, very wide. So the best thing, what I feel about exchange traded currency derivatives is options, because here you have a platform which is very, very transparent, right? And you will be able to hedge using options for 1 month or second month. As I said, currently the liquidity is for 2 months for options, but when it comes to futures, you can hedge for 12 months. But options, currently it's liquid for first month and second month. And you also have weekly options on USD INR. You can do a plain vanilla option. If at all you're an importer, you can buy a call option, which is nothing but a right that you have to buy the dollars, or you can buy a put option in case you are an exporter, right? You can also have a combination of futures, options. You can do a bull call spread, or you can do a cost reduction structures. You can do a range forward. Now, when I take options and all these strategies, it's again a long session. It will take at least a half a day. This is one of the sessions that we are doing for the corporates for the first time, and going forward, as per your recommendations, if required, in case you put it in the feedback, we'll also do similar sessions on options, which will help you, where we'll discuss about different strategies that can be used. Yeah. So summary is, options are one of the best tools when markets are volatile. Combination of options are very good, and on exchange platform, it's transparent and very easy to use. Uh, Even though, as I said, we are not just comparing forwards and futures. Currently in the market, if at all you look at 100 exporters and importers, 90 to 93% of exporters, importers even don't hedge. The first step for them is to get onto the exchange platform, do a futures, because the documentation is very easy, right? One can take exposure by giving a small margin, so on and so forth, right? So I'll just compare the difference between forwards and futures, because both work in almost a similar way. Uh, who can all participate in exchange trade currency derivatives? All corporates who are exporters, importers, resident Indians. If there is some resident also who wants to take a exposure, who wants to trade, he can trade on exchange, and FPIs are permitted. On the OTC market, if at all you look at, only corporates can participate there. And to hedge on the OTC market, which is banks, you require an underlying, where you have a contract to hedge that, or you require a past performance certificate. Past performance certificate is nothing but you need to take it from your chartered accountant, where he'll certify saying that last 3 years, what was your export or import, and with past performance, you can book any of the 3 years highest export without giving an underlying. So there's a lot of paperwork which is there to do a forward and or an option on the OTC market. Second thing, the bid ask spread is very, very narrow and tight on the exchange platform. It's just quarter paisa, the difference between buy and sell. I've just put a screenshot here. If at all you look at the bid price, this is today's screenshot at 236, is 73.27 and ask is 73.27.25. So what I mean to say is the buy sell difference is very, very narrow, and it's only one tick or one quarter is what is the difference. Whereas if at all you look at the bid ask spread, on the OTC platform, I've just put a screenshot of a ticker plan, and just look at March 5th serial number. The difference between buy sell, the premium buy sell difference is there 11.25, 13.25. It's minimum 2 paisa plus whatever the bank charges. So point one, many can participate. Second one is bid and ask is very tight. Third thing is the prices are transparent. There is no loading on that. There is one fixed brokerage which is applicable in case you trade on exchange. Whereas when it comes to OTC, they'll give you a bid and ask price. Plus, there is also a markup which the banker charges, and that depends upon the knowledge or the tool that you have in knowing the spot price, right? So the prices are not transparent there. You can hedge even a small lot of $1,000 on the exchange platform, whereas on the banking platform you can start hedging from $25,000 to $50,000. Accessibility, anytime on your mobile or on your web, you will be able to trade and hedge on the exchange platform. Whereas when it comes to bank, right, you need to call up the dealing room, speak to the dealer, speak to your RM, take the quotation of the rate. If at all you're comfortable, then you book the deal and then you'll get a contract, right? And in pandemic times, the timing also has been shrunk in the banking platform. Banking platform is open only from 10 o'clock to 3:30 now, whereas exchange platform is open from 9 o'clock to 5 o'clock. So you have got an additional window of almost 2.5 hours on the exchange platform, right? Credit exposure, yes, every transaction on exchange platform is guaranteed by the clearing corporation, whereas on the OTC, there might be a counterparty default risk. Prices are very transparent. You can see 5 bid and ask here, and on OTC market, it's only the God's word, whatever the dealer gives you the price, right? And next point I'm talking, the biggest advantage is options, which I've been harping in my presentation from the beginning, right? Not all bankers offer you option, but here for 2 months, good liquidity, you'll be able to hedge using options also, right? The last point is on the margins. In case any corporate has got any credit limit and he has got a set forward limit with the bank, there is no margin which the bank asks, or they don't ask for MTM, right? The settlement happens at the end. But on the bank, on exchange platform, you need to give an initial margin, which is approximately 3 to 4%, and there'll be a daily mark to market. Daily mark to market, if at all it's positive, you can also take it off, and if at all it's negative, you need to hold your transaction, you need to make the mark to market good. So these are the few of the differences which are there between exchange trade, currency derivatives, and the OTC market. I showed you, this is the screenshot on the forward markets, right? How the prices are quoted. These are the NSE futures contract, which are very transparent. Yeah. And as I said, this is the screenshot on currency options, very transparent. You can see what is the call LTP, right? You have the strike prices in between, then you have the call LTP, then you have the put LTPs. Entire data is transparent. Okay. This is the most important slide which I wanted to show you. As I said, this slide is taken somewhere around 2:30 today, 2:36. The volume which happened on exchange platform till 2:30 on NSE was approximately 60,000 crores. Here on the right hand side, you can see what was the turnover last 3-4 days, right? On yesterday was 70,000 crore, day before yesterday was 87,000 crore. So what I'm going to say is almost $10 billion is what is traded on a daily basis. So it's pretty liquid. All 12 months you'll be able to buy, sell. The impact cost is very, very low. Moving ahead, guys, is my screen visible? Now this is very important. Who don't understand about the currency futures and trying to understand for the first time, the contract specification is important. Yeah, here there are 4 pairs against USD against INR which are traded, which is USD INR, Euro INR, GBP INR, and JPY INR. Each lot size for USD INR is 1000 USD, Euro is 1000 Euro, GBP is 1000 GBP, whereas Japanese yen is 1 lakh Japanese yen equals to 1 lot. Reason being, today almost $1 equals to 110 Japanese yen, or Indian terms 66 paisa is 66 paisa will be equal to 1 yen. So approximately 1 lakh Japanese yen will make 66,000, which is the lot size for a. So tick size, yeah, all the quotations is in INR, right? For $1, 1 euro, 1 GBP, or 100 JPY. Tick size is quarter paisa. So when I say, let's say rupee dollar is trading at 70 rupees, 72 rupees 30 paisa, next uptick could be 72, 30, 25 paisa. right? 30.25, 72 30.50, 72 rupees 30.75, and then 72.31. That means for a movement of 1 paisa, 4 ticks has to move from 30 to 31. These markets are open Monday to Friday, 9 o'clock to 5 o'clock. In futures, you have 12-month trading cycle. Every month, the contract expires on the last working day minus 2 days. Let's take the June month. The last working day is 30th, which is Wednesday. So 2 working days before is Monday, which is 28th. The contract expires on 28th at 12:30 RBI reference rate. Okay, after 12:30 RBI reference rate on 28, the next month contract, which is June, can be traded, but July can be traded, but not the June. Settlement, in case you square off the transaction in bit before the expiry, it's T+1, and final settlement happens at T+2. Margins, as I said, margin required is close to 3 to 4%. So these are the contract specification on the futures side. Yeah. Let me also just go back 2 slides. Other biggest advantage is, in case any of you corporates have exposure to euro, pound, and yen, just look at the bid-ask spread here. Euro, the difference is 3/4 paisa. GBP is just a quarter paisa, and JPY is approximately, today the bid-ask is higher, is close to 4-5 paisa. And I'm telling you, at OTC, these spreads will be much higher than what we are seeing. So I was talking about Euro USD, 1 tick difference, but on the cross currency pairs, any day the pricing on the exchange platform will be much better than the OTC platform. Going ahead and moving to NSE option contract specification. There are 4 pairs again on options: USD INR, Euro INR, GBP INR, and JPY INR. Lot size is 1000, like how we have same like how we have in futures. Again, the tick is quarter paisa. Markets open from Monday to Friday, 9 a.m. to 5 p.m. And for every ATM, whatever is traded, you have 12 in the money and 12 out of the money strike prices, which are available for trading. And each strike price is of 25 paisa interval, right? And in USD INR, you also have weekly options which are traded, right? Monthly option expires last working day minus 2 working days, but weekly option expire every Friday at 12:30 RBI reference rate. Okay, so in case you have some exposure 2, 3, 4 days and you're not hedged it, you think there's some event, you can hedge, you can use weekly options also, right? This is on options. Are you able to see the next slide? How much you can hedge, right? On an exchange platform, USD INR, which includes your futures and options, you can hedge up to 6% of the open interest or $100 million, whichever is higher. And today, I just showed you the screen. You look at what is the open interest here. Open interest is 85,79,000 contracts. I just gone back to the previous slide. I'm on this total. You can see the OI, bottom line is 85,79,000 contracts is what is the open interest. So 6% of this is approximately $500 million. So a corporate or an individual can maximum take $100,000 or 6% of the OI, which is $500 million to hedge, which is pretty large. I'm sure it's more than sufficient, right? Similarly, these are the OI and the gross positions which can be taken on other currency pairs, and these are pretty okay for any of those companies, let it be SME, medium enterprise, or even a large enterprise. Guys, are you able to see my next? Yeah, I think there's a time lag, so I was just trying to confirm. Yeah, I just wanted to give few case studies like how futures options can be used by importers and exporters. Let's take this first one: hedging using currency futures for an exporter. Right? Let's say you are an exporter, and today, let's say the date is 1st of April 2021. You have exported something. You are going to receive export receivables of $100,000, which will come after 2 months, which is 31st of May 2021. It's just a hypothetical scenario. Let's say rupee dollar price today is, which is 1st April, is 74 rupees 50 paisa. With 2-month forward premium, the 31st May price would be 75 rupees. Everybody clear till here? If yes, just type yes in the chat box so that I can have a concurrence from you saying that we are all on the same page. Can you just type yes in the chat box? Yeah, thank you. Thank you. Yeah. So let's say you are an exporter and you have exported $100,000 is your exposure, 74.50, and you have sold your exports at 75 rupees, right? As I said, here each lot is of $100,000. So here to hedge $100,000, you need to sell 100 lots. Okay. So at a notional value of 75, it will be 75 lakh rupees is what is the contract value. Now, two case scenarios. On 31st of May, right? Let's say INR appreciates and closes at 74. What will happen? You have sold your dollars at 75. On that day, the price is 74. So you make a gain of 1 rupee on exchange platform for 100 for your 100 lots. It will become 1 lakh rupees. Okay, and you go to the bank. You need to go to bank because this is a platform where it is all cash settled, and you will receive your dollars in bank. You get it converted at 74. Bank will give you 74 lakh rupees, and on the exchange platform at ICICI Securities, you will gain 1 lakh rupees. So net you thought of hedging your price at 75. It holds good. Similarly, let's take another case. Case 2, I talked about appreciation. Let's say INR depreciates from here and goes to 76 from 75, right? So you have sold at 75. It's mentioned 77. It should be 76. It goes to 76. So you lose 1 lakh rupees on exchange or at your ICICI direct trading platform, right? You go to the bank. Price is 76. Bank gives you a credit of 76 lakh rupees. You lose 1 lakh rupees here. So net you thought of hedging your price at 75. It holds good. So if rupee moves either ways, let it go to 74 or 76 from 75, your price is hedged and it's fixed. I think is this case study clear to everybody? If yes, please type yes. Okay, I'll go a little slow. Yeah. Thank you. Similarly, this is the second case study, how an importer can use currency futures. Okay, I think there's some time lag. Are you guys able to see the slide now, which has got a hedging using currency futures for importer? Okay, thank you. Yeah, same case study. Let's say you are an importer. 1st April, you need to make a payment of $1 lakh on 31st of May. Today price is 74 rupees 50 paisa. You need to pay premium and you need to hedge at 75. So you bought your dollars at 75 rupees, right? $100,000. Again, you buy 100 lots. Two scenarios. You bought at 75. Price moves to 76. Okay, now you gain 1 lakh rupees on your exchange trade currency derivatives platform. And case study 2, if at all it moves to 74, then you lose 1 lakh rupee here, but you'll make your import payment from the bank at 74 rupees. Yeah, you here I'm using the case study 1 from 75. Are you guys able to see my cursor? Okay, if the hedging price is 75, it goes to 76, right? You've bought at 75, now you sell at 76, you make 1 lakh rupee gain on your trading platform. Similarly, if it goes to 74, you have sold at 70, you have bought at 75, but the price is now 74, you have to sell at 74, so you lose 1 lakh rupees. But you go to bank, make your import payment at 74 rupees, right? And you have lost 1 lakh rupees here. So net your 75 rupees holds good. So if rupee moves either ways, let's say 74 or 76, an importer is hedged. So I thought I'll share these two case studies, how it works for an exporter and importer using currency futures. Let's move ahead. Now, this is a case study. Similar case study, same numbers I'm taking using currency options. Let me take an importer first. As I said, the importer will be buying a call options, right? And I'm talking about a plain vanilla simple call buy option, right? It's 1 lakh rupees that importer has to pay after 1 month. 1st April is the date of transaction. 31st May is the date of payment. Now, let's say the spot price is 75 rupees and the call option premium, let's say, is 10 paisa. So as I said, options is like buying an insurance. Yeah, let's say you buy a car which is worth 10 lakh rupees. You need to buy insurance for that. You pay 20,000 rupees, buy insurance. If for that entire year no accident happens, good. That 20,000 rupees was an expense. But in case some accident happens, since you have taken an insurance, it takes care of the cost of getting it repaired. So same way, here you pay 10 paisa, and 100 lots 10 paisa is 10,000 rupees is what you pay to hedge your 1 lakh import payment, right? So let's take a scenario. Let's say it moves to 76. If at all it moves to 76, your premium from 10 paisa will be closer to 90 paisa. So you'll make 90,000 rupees here, right? And you go to the bank, and since it's 76 rupees, right, you make a import payment at 76 rupees, but you have made 90,000 rupees here. Similarly, look at this case study. I'm just using my cursor. in case, right, INR appreciates and it goes to 74, right? No accident happened. You've just paid the 10 paisa premium. That's a cost which is gone, right? Instead of 75, you go to the bank, make your import payment at 74 rupees only, right? And the cost has been 10 paisa that you paid to buy a call option. So if rupee depreciates to any level, right, maximum loss would be up to the premium paid. Even though it goes to 72, 71, it's all good for you to make an import payment at a lower cost. But in case any upside it goes upside, it's all protected. So this is how call options can be used by an importer. Is this clear? Any questions on this? Okay, let me move ahead. Yeah, similarly, how options can be used for an exporter. Now here exporter will buy put option. Let's say same thing. He pays 10 paisa as a premium, right? Price moves to 74 rupees. So he'll get 90,000 rupees and he'll be able to convert at the bank at 74 rupees and he'll get 90 paisa on the exchange platform. Look at my cursor. If at all it goes to 76, I just need to make it 76. So upside is all his. He'll go and convert it to the bank at 76 rupees or 77 or 78 or 79. But the cost which he would have incurred is that 10 paisa, which is 10,000 rupees. So if rupee appreciates to any level, maximum loss would be up to premium paid. If rupee depreciates, all his upside is to the exporter. Yeah, guys, moving ahead. Now, quickly coming to benefits of trading in currency derivatives. I mentioned first thing is they're transparent, they're liquid, very tight bid-ask spread, very easy to trade, long trading hours, right? And apart from that, the other benefits are the margins required are very, very low. Yeah, options, any large corporate can use. As I said, most of the banks don't offer. You can buy options here to hedge whenever you think markets are very volatile. So here, but for futures, the margins are very, very low. There is no STT, no CTT, and there is a very, very small regulated taxes, which is exchange fee, SEBI fee, and a stamp duty on the buy side. The transaction charges are very, very low because there is no STT or CTT. Coming to the next slide, why should someone choose ICICI Direct? Reason being, we are a bank broker, we have a strong management. There is a robust risk management which has been set up by ICICI Securities. We have great research. One can very seamlessly transfer the funds for a 3-in-1 account. Competitive pricing. There's a research support, advisory support, and it's not only currency derivatives. You can do many, many more other products also. In case you have equity exposure or you want to hedge your commodities, you can all do it at one platform. It's very convenient to trade. You can trade on mobile, you can trade on your website. So it's very, very convenient. And we keep doing a lot of investor education programs like this, like the one that we have been doing. So, and there'll be many, many more going ahead. We also give research reports, right? All research recommendations are available on iClick to Gain. We come out with daily currency report, weekly report, monthly report, and specific report in case of any major event. All these reports are available on our website. I'll just try to share a link of our latest report also, or my research colleague will discuss with you at the end. And there I come to end of my presentation. As I said, this presentation is purely for education purpose on educate how corporates can use exchange traded currency derivatives and hedge their foreign exchange risk. So that's all from my side. Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.